Hello, mortgage fans. So it's been a week since our last update, and as the old phrase goes, a week is a long time in politics. Let's not go there, it's far too easy. Funnily enough, I was having a really busy week last week, and on Friday my WhatsApp just lit up like a Christmas tree. So I'd look up what the story was. I was just like, oh, you silly boy. But anyway, back into the more exciting world of mortgages. So last week I was cut a little bit short when I was talking about inflation, so I'm going to pick up that theme. Because also the Bank of England had their meeting last week. So those two things tie in really, really nicely. So I'll expand on a bit more on that. Also, there was some data released from a company called Knowledge Bank. They look at lenders' criteria and they're seeing some trends that sort of making lending a bit easier. So we'll sort of break that down in a bit more detail also. And then ultimately how that plays into the market. So what impact is that having on interest rates and what are our thoughts about what the future might hold. So going back to that first point then around inflation and interest rates. So last week, as I say, the Bank of England met. Specifically, it was the MPC meeting, which is the Monetary Policy Committee. That's the board that decides where the UK benchmark interest rate should be. They voted unanimously to keep interest rates at 0.1%. So no real surprises in that. They've been quite open in their view that although inflation is going to go above target level in the next few months, they just want to sort of wait and see how it goes. And I completely get where they're coming from, because we're at sort of a phase sort of where we are in economically, where year-on-year comparisons are sort of pointless. Because normally what you do is say, well, this time last year we were wherever. This time last year we were deep into lockdown, the onset of COVID, no one really knew where we were. So those year-on-year comparisons are sort of pointless. So I completely get where they're saying is that let's just see how this plays out over the coming months. Inflation is targeted to keep going up. Sorry, not targeted, it's predicted to keep going up. So I won't be surprised that continues to rise over the next few months. You know, you could look at sort of things like the US, their inflation is really quite high and other economies are suffering inflation. So it doesn't necessarily mean we'll follow suit, but those global trends do play a role. So just something we've got to think about. Also, we've not really dealt with Brexit and what that really means as well. So what impacts that can have on supply chains, etc. So there's a lot of stuff going on. So exactly why I get why the Bank of England just holding fire. Because in a sort of normal situation, what you'd normally see is if inflation is going up and GDP is going up, certainly when inflation is above the target level of 2% from the Bank of England, you would raise interest rates. That's the sort of the normal thing to do. But we're in far from normal times. So I completely get their wait and see approach. I personally wouldn't rule out a base rate rise this year. I think it'd be like Q4 or maybe even Q1 next year. You could see that. And it may well just be the reversal that we saw of going from 0.25% to 0.1. That was sort of the emergency cut back last year. So I wouldn't rule that out, but I think you can look at that past September, because up until September, you've still got the furlough scheme running. So that sort of masks a real sort of impact of what's happening with the economy. Still lots of stuff to shake out. So I think really once we, as I say, we get into Q4, if things keep going the way they're going, inflation keeps going up and GDP keeps increasing, I really wouldn't be surprised to see that. I'm going to touch on that point again when we look at the market rates toward the end of the update as well. So one to keep a really close eye on. So I think we could be months away from a price rate rise rather than being years away, like it looked like a little while back. And then just to go full circle on this, you know, funnily enough, even just a few months ago, we were still talking about negative interest rates. So a lot's changed in a short space of time, hence the wait and see approach, which I think is quite sensible. So second point then is around lender criteria. So there's a company that we work with called Knowledge Bank. What they do is they're sort of a sourcing tool for lenders' criteria. So what you can do is that what do banks do in different areas, if you're on a visa, if you want a large multiple income, that sort of stuff. So really, really useful tool for us. Now, because they track banks' criteria, they're actually a really useful barometer of the market because they get to see what's going on and certainly pick up trends. Two big trends they've seen over recent weeks are, one, that products are back to pre-pandemic levels pretty much, and that's been driven by 95% mortgages coming back. So a lot of press has been made about that. I see a lot of TV adverts as well, so that won't have passed you by. But that product choice just really, really makes it easier for people to buy. So that's obviously a huge help. Which then goes into the second trend they're seeing, which is lenders are loosening their affordability criteria. So in English, that means banks will lend you more money. And to put some numbers to it as well, this is really sort of geared around high earners. So there's one bank now, if you earn over £200,000 a year, they'll lend you 6 times your income. And there's quite a few lenders now where if you earn over £75,000 a year, you'll get around 5.5 times your income. And an increasing amount of banks are taking 50, 65% or 100% of your bonuses and commission. Now, the reason why banks are doing that now is, say we're sort of a year on from COVID, if you still have a high paying job, still being paid bonuses or commission, you're a pretty good bet for a mortgage, because if you can hold that up through that period, well, sort of chances are you'll continue to do that in the future. And again, one thing I want to stress, this is getting back to pre-pandemic levels. This isn't like a new thing. We're not sort of loosening the straps completely, people going nuts. This is just going back to where we were in, say, 2019. So quite positive that product choice and criteria is getting back to that point. And then ultimately that will fuel a conversation around house prices. There's been a lot of negativity about that. I spoke about that in detail last week, so I'm not going to do that again. But the point being is, if more people can buy and can buy more in the second half of the year than they can in the first half of the year, I think that will mitigate a lot of fears around what people thought might happen with house prices falling this year. Don't see it happening. But again, look at last week's update if you want a really detailed response onto that one. So last thing then is how that sort of plays into money market rates. So we're starting to see quite a solid upward trajectory now, particularly 2-year money's on the way up. 5-year money's just sort of steadily increasing, has been the last sort of few weeks. And then that sort of plays into sort of the best rates you can get for a mortgage then. So if you've got a large deposit, around about 40% deposit, the best rate you can get on a 2-year fix currently is 0.95%. I repeat, 0.95%. And a variable rate can be picked up from 0.99, and a 5-year fixed you can get at 1.14%. So if you sort of round all those things I've talked about today, with inflation potentially on the up, certainly lender criteria loosening, GDP increasing, we could well be seeing the lowest mortgage rates ever. Now, I have said that a few times over the years, but the base rate's never been at 0.1 before. So I think it's a really strong argument to say that actually these could be the lowest rates we're ever going to see over the coming months, or certainly through the summer. So some of those trends are going to keep a really, really close eye on. It'll be really interesting to see, do banks start moving up from that 0% area? So one I'm going to look closely on, and no doubt I'll touch up on that next week.